Hi there, my name's Chris Walling. I'm the CEO and founder of Daily Rag Trader, and this is your morning market hit for Monday, 20th of May. It's around 9 a.m. London time. And so the question is, what matters for markets? What matters if you want to trade equity index futures on a 1 to 2 week basis? What factors should you be looking at? What should you be thinking about? And how should you go about timing an entry into a long or short position of S&P futures or Nasdaq 100 or FTSE or DAX? That's what we're going to dig into in this video. Well, it looks like upside momentum in equity markets has stalled in the last couple of days. So look at this GIP chart of the S&P 500 that we're putting up in front of you now. Markets surged last week, in the middle of last week, on the back of Wednesday's US inflation data. Terrific move, very strong to the upside, but since then, very flat. Flat Thursday, Friday, and flat overnight in the Asian trading session after the weekend on Monday morning. Similarly, if you look at the Nasdaq 100 chart, very similar price pattern, surging on Wednesday and flat since then. Elsewhere, there's been quite a lot of action in other parts of the global financial markets. So if you look at some of the commodity indices, take a look at copper. The copper price has been very strong back end of last week. In fact, very strong for several weeks now, with the price moving from around $4 to $5 per ounce over the course of the last several weeks. Similarly, look at silver, surging on Friday, up over 6% on the session, really strong in the last few weeks as well. So there's a lot of action in the commodity spectrum, but equities appear to have stalled out. And it leaves us with the question, is US equity momentum stalling? Or are equities in the States about to do what we're seeing in commodity prices and surge again to the upside? And clearly last week's US CPI data was helpful in that respect. Very benign number, lower than expected. Core CPI came in better than expected. And of course the narrative in markets in the last few months, so over the course of most of this year, on inflation has been that it's sticky. And the data's disappointed on inflation. It's been a bit sticky, a bit higher than people have expected until last week, when of course we had the opposite, better than expected, less sticky, some softening of inflation. And actually, as you look in the breakdown of the various different components, some encouraging news flow, and markets surged on that. But that's old news. That's in the past. That's priced in. The market priced that in on Wednesday very quickly. Very good move on it on the back of inflation, but immediately in the price. And of course, inflation itself is a backward-looking indicator. So the market's priced in that bit of good news. You can see that in something like the put to call indicator. If you look at the amount of downside protection in portfolios, the amount of puts outstanding relative to calls, you can see that it's at very low levels. The chart we're showing you now has the put to call ratio inverted. So high on the chart means a low level of puts relative to calls, which is where we've got to in the last few days, with the indicator going back to sell. In that sense, traders have removed their downside protection, they moved their protection that would support their portfolios if the market sold off. And it's indicative of complacency across the board. Short-term complacency in markets, a belief that the upside is the only way these equity markets are going to go. And you tend to get that near local tops on that sort of 1 to 2 week basis. When the put to call indicator gets back to sell, there's no downside protection in portfolios. The market is now vulnerable to the downside because no one's protected to the downside. And similarly, quite a lot of our 1 to 2 week market timing models, that's a consistent time frame with that put to call ratio I just put up in front of you. Consistent with that, these models are also getting back to sell. So for example, here's the S&P 500 technical scoring system. This is a model we put together every day, publish every morning with a Daily Rag Trader. It aggregates a whole bunch of technical models, scores them all, adds them all up and generates the scoring system, the technical scoring system for the S&P 500. We have this for the Nasdaq, for the Philly stocks, for a whole bunch of indices. Every day we publish the S&P one. As you can see, it's back on sell. It's been quite timely, quite useful in the last few weeks. It's generating a sell signal consistent with what we saw on the put to call ratio. And indeed elsewhere, we have all sorts of other types of models. So our market vulnerability model, for example, which we're putting up in front of you now, this measures complacency and conviction. And when there's a lack of conviction and high levels of complacency, it generates a signal as it crosses that the green threshold line that you can see in this model. And once again, it started generating a signal in the last few trading sessions, reiterating that on Friday. So there's a whole bunch of short-term market timing models that we use for 1 to 2 week trades that are starting to generate sell signals. If you take a trial of the Daily Rag Trader, you'll see the full list of them, a whole bunch of them that we update each and every trading session we publish when we publish the Daily Rag Trader every day. And in that, we lay out our view on 1 to 2 week trade recommendation on an equity index future, typically the S&P 500 futures, but sometimes NASDAQ and others. And it's available for a trial if you click on the link below. And of course, if you're a subscriber, it should be in your inbox around 8:30, 9 a.m. London time each and every business day. So what are we watching today and this week that matters for markets? What are the key events we're keeping an eye on other than all the price action? Well, firstly, we're pretty focused on the flash PMIs coming out later on this week on Thursday in Europe and across the States, indeed across the globe. They give you a good insight into May's economic activity pretty early on in the month. Obviously, we haven't quite finished the month yet, so you get a good take on the first half, 3 weeks of the month. That's the first key theme. Secondly, all eyes on Nvidia. US earnings season is coming to a close. We're nearly finished, but Nvidia is a big one that's out this week. It's a key stock. It's been a key leadership stock. Its earnings have been terrific in recent quarters. That comes out on Wednesday. That'll be a big focus for markets. And then finally, the third theme is bits and pieces of data. Fed minutes out on Wednesday. They'll be watched closely. Also, we've got existing home sales out of the States, again, Wednesday, and then Japanese inflation on Friday. So plenty to keep an eye on over the course of this week. Lots of interesting price action. Is that consolidation going to continue in the S&P 500, or is the market starting to roll over? So that's it from us. That's your morning market hit for Monday, 20th of May. Thank you for listening. Please do subscribe to these videos on YouTube, like and share on social media, or follow us on Twitter, LinkedIn, and or Facebook. Thank you for listening. Stay safe, trade well.